The Hedgeless Horseman here. It's February the 26th, 2024. First of all, thanks to the sponsors. New week, futures, silver down, copper down, gold down. And like always, this could totally change within the next 12 hours or so. And if I had to guess, whatever we close at, if we're positive, I'm gonna guess the metals will be negative the next day. If we close negative, I guess the metals will be positive the next day. Like always, it's everything is noise. It doesn't matter. 1% up or down doesn't matter at all, really, in the big scheme of things. One interesting thing that's just pointing out, I think, that this sector, the mining space, is incredibly undervalued. Like, opportunities, some people would argue, have not been seen in decades. So first off, we've obviously seen, and I pointed this out, that the typical mining billionaires, the ones who are strictly focused on mining, are good at mining investing, they're pounding the table right now and have been for, increasingly so, I would say. I mean, Rick Rule basically seems to be trying to turn around the sector single-handedly because he's in so many interviews. And it doesn't take a lot at these sentiment levels. I mean, not a lot of buying power is needed to have some of these juniors up a lot, and we've seen that as well. Some juniors can move 40% with $4,000 worth of buying. Typically more the micro cap, nano cap stocks, but still, it just goes to show that this sector is so liquid, it's so dead, that you don't need a lot of lifeblood in terms of buying for them to actually rise from the dead relatively quickly. And I mean, alarm bells, buying bells really should be going off when we're seeing generalist billionaires seeing this sector being so cheap that even, in this case, Elliott Management is setting up a company to invest at least $1 billion to buy mining assets globally as it seeks to take advantage of the depressed valuation of groups operating in the sector. People familiar with the matter said. We're talking a billionaire, and they're quite unwieldy, obviously. I mean, they can't buy micro nano cap stocks or anything like that. So I mean, they're taking the effort to build a new company or set up a new company. They hired the ex CEO of Newcrest Mining to lead the charge. I mean, that speaks volumes. That we're seeing someone who's probably not too interested in mining per se, because he's probably made most of his investments, or most of Elliott Management, or most of Paul Singer's investments probably have not been in mining stocks. So when you see someone like that stepping out of his comfort zone, really, then he sees something just incredible. That they take the time and effort to build a new company just to right now take advantage of the current valuations out there. This is just incredible, in my opinion, and just again goes to show, most of the people that are aware of mining aren't buying. How many people out there on Twitter are actually bullish? Almost everyone just focuses on how big their paper losses are over the last 3 years. And are not in a good mood. They feel it's a real curse to be here simply because of the paper losses. While, as always, max pain comes with the max future gain. You will never have higher paper losses than at the bottom tick of the market, and the biggest future reward comes at the bottom tick as well. So the cure and the curse come together at the inflection point. The low, you've lost most, max amount of money on paper, but from there it's the best possible future you could come up with, because the low means, okay, the next several months or years it's going to be up. But obviously almost everyone just looks at what has happened, so it's like 95% of people see this current environment as a great curse, and most people don't even know. I mean, they're more likely to sell because it hasn't worked. When you see people like this, who obviously doesn't care much about how poor the sector has performed, it's that they believe from these levels, where we are at right now, after having fallen so much, Paul Singer obviously sees an enormous opportunity of making money in the future. So that's, I think, something really to pay attention to, because this is not a dumb person, and this is not even within his or Elliott Management's circle of competence, but it's just obviously, and we see this in charts. I mean, I've shown the, Nvidia, the Nasdaq to HUI ratio, which is at, the high since 2000, which was the start of an 11-year-long bull market. Maybe something like that is in store for us, and that's obviously, if that's the kind of opportunity that could be possible here, obviously that's probably something that would get even a generalist billionaire like this to invest in the sector. So it's if you're bullish now, you're on the side with some of the smartest people in the entire world, including the people that know the mining business very well and made a lot of money from buying low and selling high, which are the Ross Beatties and Landins, etc., Rick Rules. But you also have this kind of vote of confidence on that particular, on the case for mining, basically. So it's just absolutely incredible. Again, think about it. Okay, if you're bullish now, there's no retail bullish. There's not much buying out there, right? 1 billion into, that would lift the entire junior sector if somebody just put in $1 billion today or over the next 6 months. So it's like, if you're bullish right now, you're a tiny minority, but you're on the same side as billionaires and some of the absolute best general billionaires there is, if you know what I mean. It's like they're not forced to go into mining. They typically don't go into mining. They do this because in their eyes, this might be a generational buying opportunity. And I've shown this before, I think. This was posted on Twitter some weeks ago. This is from a book where it kind of goes through how the sentiment cycles work. And this is why I keep saying that. The market is really a silly place, and it took maybe 5 years to learn or understand just how much sentiment drives everything, especially in the short to medium term. And it's, going from extreme to extreme, that sets up the big opportunities, because we don't know exactly where the value was in this chart, but it's probably surpassed value during the thrill and euphoria phase, and probably undershot value during the anger depression phase and capitulation, and it's gonna forever oscillate between these two. So somebody showed this chart, or somebody put up a chart of Abercrombie and Fitch. I don't know much about this company. I think it's a American clothing brand. So let's put it like this: it's probably quite a boring company, if you know what I mean. I mean, it's been around for, I was gonna say ages. I mean, at least since 1996, probably before that, because I think it's a very old brand. But you can kind of see this is not a log chart, but you can kind of see this. It's like it topped in 2007, late 2007. And for the next 17 years, it didn't see price as high as this peak. Right? So after this top tick, every single buy kinda looked, well, if you bought here, let's put it like this. If you bought here, for 17 years you would not have seen those prices again. And actually a lot lower prices, down to 84, minus 89, minus 90. And we're gonna focus on this, but just keep this in mind. It's like, okay, something is down 90%, okay? Or first this was like 83, huge rally. Down quite a bit later on from this top, obviously, but it's like, okay, it got extreme, got down to minus 91%. And for 17 years, this was a very depressing stock to own, basically. That is, I mean, that's half an adult life, I was gonna say. 17 years. So this maybe was such a, I don't know what sentiment was back here, obviously, but okay, for 17 years, it went sideways to down, peaked out at a paper loss of 91%. Everybody looked like a complete idiot, basically, for if you ever bought Abercrombie and Fitch, somewhere between this period to here. On average, it's like you could have bought here and obviously made really good paper profits in a short time frame. But it's like most people are gonna look at this chart and see depression, because it's simply down. And most people don't actually, again, most people don't buy here, have a fat paper profit, a sellout. They don't buy here, sell there. I mean, most people never even buy low. They just look at the overall trend. And this is a depressing chart for most people, even though obviously, like in a lot of stuff, if you bought something that has crashed, you tend to end up making money if they're still around. If the case hasn't, I mean, completely imploded. But okay, so for 17 years, excuse me, this traded lower. What happened then? Okay, you have this kind of, I mean, you kind of have this inverse head and shoulders thing. It's like, gets kind of killed. I mean, this is obviously pretty big swings, but it's like, you know, bouncing along a bottom, let's say. And here you have some kind of, let's say, left shoulder. Here you have a peak depression down here, and then it's like nobody still cares, really. Nobody still cares. Okay, it starts to tick up. Nobody has any hopes because they've been looking at this. In this case, they've been looking at all this movement. So why would they be bullish now? Because for over 10 years, it looks like nobody's made any money. And then you have, again, peak depression. You have a bit of a higher low, peak low, right shoulder. And here, why would you be excited? Why would you be excited about this stock after seeing this? Would anybody buy this? A downtrend that's lasted for, you know, close to 17 years? I don't think so. I think most people would be seen as complete idiots if they would have bought Abercrombie and Fitch here, because there's no proof, no recent proof really of it ever returning anything to shareholders. And then within just 1.5 years, it went up 750%, a bit more than that actually, from the right shoulder here. Actually, 1,000, and this is what I mean about the near extreme lows. The opportunities go absolutely ballistic, because at face value this might not look like a big difference. If you bought here, here, or here, down there, it just looks low. I mean, in hindsight, when you are here, it just looks like, I mean, what's the difference? This looks low. It looks like it's doing the same thing. It's just been killed and has some breaths of life some time and then goes down, whatever. I was like, when you think about what happens in a bull and you compare how much difference it makes by just buying more the cheaper something gets, assuming again it's not a totally busted case. This low here, 750%, 760, 1,446%. At face value, these look like relatively similar buying opportunities. But when you fast forward, given how it goes exponential the cheaper something gets, it's like this was minus, let's look at that again actually. So this was minus 89. This was minus 91. Minus 89 is a big fat paper loss. Minus 91, or minus 89 and minus 91, it doesn't seem to be a big difference. Like, who cares? Okay, crashed 89, now it's down 91. Who cares? I mean, it's pretty much the same buying opportunity. But it really isn't. It's just because everything is relative. So even this drop here, for example, that doesn't sound like much, but that's 20%. Again, doesn't sound like much, especially if you're down 89%. It's like, okay, great, now I'm down even more, 20% more. But this is what I'm talking about, the volatility, and I constantly speak about this. If you see some juniors right now, for example, let's say Intact stores, if they go down 20%, you might think, well, that's not a big deal. I mean, it's just worthless, becoming more worthless. But you have no idea how somebody that, let's say, puts in a market sell order or is scared or gives up, whatever, he takes an illiquid junior, he brings it down 20%. The future expected returns for the people that are buying his panic selling, or it's like, throwing the towel selling, you have no idea if all of a sudden that stock might go from, let's say, 1,200 to a future return of 1,000. That's 300% more future theoretical returns. 300, which is like, you would be happy to have that result over 5 years, really. I mean, that's much better than the market. That's an added 300% return from just getting a 20% dip from already extreme levels. So minus 20 from, let's say, the week prior. You have a stink bid, you get hit, you might have netted yourself 300% extra in the future. It's absolutely insane how much the risk rewards change at around these extremes. Absolutely insane. And that's what I'm talking about when it's like value shuffling. Now people are despondent because they're looking at it like, why does it matter? If, let's say, you're down 89% and it's like, oh, you're down to 92. At face value, it doesn't feel like any difference. It's like, why should I even be active? Why should I care if, these absolutely killed mining stocks go up 10 or 20% or down 10 or 20% rather? It's like, why should I even care? most people like, oh, I'm not buying until I see a turn. I mean, that's what you see a lot of people say. They're not buying until they see a turn. If something goes down minus 20%, they just get more depressed. And they won't do much about it. They might be more likely to sell, actually, because they get more depressed. But when you think about it from the end, it's like that, okay, how does this work? Obviously, the big money is in the big delta. The biggest delta is from depression to euphoria. And we know the market, especially a cyclical commodity market, or the gold sector. I mean, just the saying, like, I mean, it's like they struck gold. You know what I mean? I mean, gold is basically the poster child for euphoria and greed in some ways. And plus, it's also, a safe haven. So it's very, very psychologically charged. This sector is very psychologically charged. So if we want to make the absolute biggest returns, we need to invest in whatever sector is in around capitulation, anger, depression, and disbelief. Depression is obviously the highest future expected returns, but anywhere around these levels is good. And we know, I mean, what keeps me going, I know 100% certainty. If people invested in a cyclical sector, like they actually believe that there's a 100% chance we're going to have another bull market, people would behave very, very differently. There would be dollar signs in their eyes. They would, have a money grin, I was going to say, anytime they see a flush around these levels. People are going to scream and shout and cry if miners drop more from here. Because they're not thinking from the end. They're not thinking about investing, which is based on where we are now relative to the future. They're looking at what has happened, which they can't change. Anyway, so they're more focused about this. That's why, I mean, they get to the stage of anger and depression. They're not thinking about this, and that there's 100% certainty that's going to come. If you would be probably as greedy as me right now. I know, I've seen it many times before. Every single billionaire that's buying now has seen this many times before. That's why Pierre Lassonde says it's the easiest sector in the world, because it's so because he knows that there's an iron rule, and that's that cyclical sectors are cyclical, and to quote him, this sector always crashes and always rallies. That's why he's so comfortable buying in a crash, because he knows there's 100% certainty it's going to rally again, and then he's going to make a lot of money. Because everybody forgets that, and that's why they sell out. People are not selling in a depression because they think it's overvalued. I have not seen anyone actually throw in the towel, or say they're going to throw in the towel, with the motivation that, well, miners are simply overvalued, so I don't see, there's no opportunity here. No. They are selling out because they have become so undervalued from wherever they bought in. They bought high and are prepared to sell low, and they're gonna conclude that, I mean, they couldn't make any money, so why even bother? And given where we are right now with the recent past, they take that as evidence of why you can't make money. And they'll probably never come to the conclusion that, right, I mean, why I actually never made any money, even, over a 15-year period, is because I actually never really bought when it became really undervalued. I bought when it was getting overvalued. And then when we got into depression stages, I was more inclined to sell. I was more inclined to hold rather than buy, and they think it's kind of the same thing. No, it's obviously not the same thing. I mean, I was going to say, there's a huge difference, and I say this all the time. There's a huge difference, exponential difference between buying, holding, and selling down here. People think holding is like, yeah, that's pretty much as good as buying. No, it's not. It's not even close to as good as buying. Buying is exponentially better than, or gets exponentially better than holding during this period. and holding becomes exponentially better than selling. So selling is obviously the most extreme waste of an opportunity. That's the biggest money destruction thing you could ever do. Especially in a cyclical sector, sell low. That's the worst sin. So again, what happened? Absolutely, let's say at face value, absolutely horrific period, long period, 17 years. What happened after this absolute horrific period? You had the most one-sided rally this company's ever had since at least 1996. It's like green candle, 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 green candle. It's absolutely breathtaking what happened. And all of a sudden, from being a bag holder, at least if you bought here, let's say on average everyone was a bag holder for 17 years. At the end, well, today, every single previous buy since 1996 would at least show a paper profit. People who actually bought the lows here would be sitting at pretty sturdy results in just, let's say you bought here 485%. Sure, that's an 8-year time frame, but that's not bad at all. Let's say you bought more down here, you super used that up to 850. Once you bought down here, those buys netted 1300%, etc., etc. So basically, this was so depressed, there was no buying. Nobody even cared probably about the fundamentals, I assume, with Abercrombie & Fitch. Then it turned around, and that's the thing. Let's say you have, I don't know exactly where value is, but it's like here it was probably overvalued. Here's probably undervalued. And the thing is that people don't really buy on valuations. The thing about when you buy something that is very undervalued, sooner or later it's gonna cross fair value. Let's say fair value is here. Or it actually went up. I don't know the specifics of the company, but let's say it has gone up a bit over this time. The thing is that it's always going to overshoot or undershoot fair value. If it's cheap, if you bought it cheap, undervalued, risk is to the upside. The thing is that, again, most people don't let valuation dictate what they do. They want to buy stuff that goes up. So if you buy something extremely undervalued, even more risk to the upside, maybe fair value is up here, but when it gets going, closing in on fair value, this trend is going to look so attractive to people, 95% of people, that they're going to buy it just because it's going up. And more people are going to buy the more it goes up. So this might have already overshot value. But we're trying to front run all those stages, kinda. If we buy cheap, we put the odds in our favor that someday, if this was cheap all the time, we don't know when, but one day it's gonna reverse to the mean, and when it does, the momentum traders and everyone else is gonna go in, so it's gonna way overshoot the value you had in mind. Maybe you bought around here because you thought it was worth 55 or something. But it could overshoot that by a mile simply because this is so attractive to a lot of people. And obviously the less sellers there are, the more dead it is, the easier it is to move. So when it gets going, it requires less capital to form an uptrend, and it's the uptrend that will get more people excited. That's the thing, we're kind of front running what people are gonna do. And the more bombed out something is, the less capital it needs in terms of buying for it to form an uptrend. And it's the uptrend that will get majority excited. They will be buying after the rally has already started. And this is the TSXV. This is I think it's a nominal chart, yeah. So this again obviously looks very much like this. Atop, this was 2007, Abercrombie & Fitch, also 2007. Dead period, doldrums basically. Even had a higher high like here. And now we might be, what looks to, at least looks to be, this was probably the depression peak, I think. This is probably, here in the Abercrombie & Fitch example, it's peak depression here in this textbook chart. And now it looks like we might be forming the right shoulder, or like, yeah, somewhere along these lines, somewhere along this in Abercrombie & Fitch, even though it obviously isn't completely identical. And this is a shitty period. You know, most people think this is going to be dead forever. That's why nobody's excited. Because this is one of the worst charts I've seen. This is an index as well, which makes it even more, depressing. What do you think is going to happen when we have had this long of a shitty period? And we might be here. I think TSXV, when this turns into a bull, which is, there's 100% certainty we're going to have a bull, I think it will be one for, I was going to say the history books. And now you see again Elliott Management buying in. Is it hard to think that maybe he thinks we're around here? Sure, it might not be the absolute lowest point, but it's at least even closer to the euphoria. But it hasn't really moved yet. Nobody expected this move in Abercrombie & Fitch. That I can tell you. Why? Because if the market knew it was going to go here in early 2024, the stock would never be this low. Because this is an absolutely outrageous return in 1.5 years. So again, nobody knew this was going to happen. That's why it was so low. Otherwise, prices might already been up here. Just, back calculating what kind of return this is over that kind of period. So it was like a black swan, so to speak. Believe me, if the market thought that TSXV had any chance of going into a bull market in the next few years, it would never be this low right now. Nobody thinks TSXV is going to go materially higher within the next 5 years. But yet we have now more billionaires betting that it's probably going to be potentially a lot higher soon. So, and like I talked on K-Report recently, I've actually started to add some silver beta. I've typically said that I thought silver juniors were chronically overvalued a bit. They always traded with a speculative discount because right now, for example, gold is actually at a pretty good price, but the gold juniors are at extremely depressed levels. So there you have a speculative discount. It's not even reflecting the current state of the gold price. But typically I found that silver juniors tend to price in a better current environment than the actual current environment, meaning that it's like, okay, they're pricing in maybe that silver is going to be or silver is at $25 when it's actually $22 and stuff like that. So you're paying a premium, you're overpaying for the current because it's you have your bias. I was going to say your expectations are that silver juniors are going to go higher, but silver juniors are so bombed out now that it feels like I'm back in 2015. And one interesting thing, like I've noticed, uh, I've looked around at some silver developers, and it's interesting that there's let's say, a basket of silver developers uh, that almost trade at identical market caps. You have Southern Silver, last I checked, 36 million, Aftermath 36, Summa Silver 33, Kootenai 35, Outcrop Silver 36, Silver One 36. There's probably more. So are we to believe that these companies are almost exactly identical? The value proposition is almost exactly identical. All the risks, management team, the current resources, their future prospect, their growth potential, the grade and all that. I mean, if you combine it, they all become almost the exact same value proposition. I have a very hard time believing that. I think this is a sign just how much of trading sardines silver juniors are. Most of them. It's like somebody, that these are all actually the same companies. But it makes sense if most people, again, they buy silver juniors, most silver juniors, not for any fundamental reason except that they have silver and are supposed to be leveraged to silver. So it's like, somebody has this portfolio and okay, Southern Silver is up at 36, so he's going to sell that because it's more than Summa Silver, he's going to buy that, whatever. I mean, it's just outrageous. It just goes to show that there's nothing rational or efficient about the junior sector. And at extremes, euphoria or depression, sentiment is like everything. Because let's face it, if you were to have been a stock picker in all of these companies and you had an idea what you thought the intrinsic value is for any of these companies, at the end of the day, today, they would all have converged at the exact same market cap. That is quite fascinating. It's like they all had the exact same value creation. I have a hard time believing that. But okay, from a pure risk reward perspective, yes, gold beta is better than silver beta, simply because a lot of gold projects actually are worth at least something on paper at today's gold prices. Some silver projects are worth something on paper at today's silver prices as well, but there's a higher dislocation between gold assets, gold in the ground, and gold out of the ground. So there's certainly more margin of safety right now in buying gold developers, for example, because again, their projects actually are probably worth something, at least the better ones, at these gold prices. And overall, I would favor beta over alpha, even though majority of what my money invested is in alpha, I would say. But the lower this sector goes right now, and I've said this quite a few times, the risk reward for beta, proven ounces in the ground, proven success, sunk cost is going up more than alpha. So a lot of alpha plays are still cheap. I mean, the exploration stories, they are cheap. The lower they go, the cheaper they get. But the risk reward compared to proven ounces is not going up. Well, it's actually going down. If you can buy bank success at cheaper prices, and they are more of a when not if question. Alpha plays are still if questions. Yes, the cheaper they are, in case of success, they're going to pay off even more, obviously. But there's still the risk that they're not going to pay off, that they won't make a discovery or prove up something significant. So there's always that potential in the future where it's like, yes, it was extremely cheap. If they would have made a discovery, let's say, it could have gone up, net you 2,000 returns over the next 3 years. That, if it's cheap enough, let's say, when we go into a cheap now versus when we go into a high sentiment environment. But probable gains from a compounder perspective is, basically superior. if you can make sure to at least, a sure 300% return is better than a potential 1000% return for your entire portfolio. And let's look at some just timing. I mean, this is First Majestic. This is one of the premier trading sardines, kinda. I mean, a lot of people like to trade First Majestic if they are bullish on silver. Well, they want to buy First Majestic if they're bullish on it. And I mean, this is a clear-cut example of where you have these runaway moves. People buy just because the recent past is good, and the better the recent past looks, the more buyers will just get in with less and less due diligence. Here it was overvalued for sure, and then boom, slammed. Here was the silver squeeze basically, but you can kind of see also just the cyclical thing. It's like, okay, tops, well actually top back here, but I take this to make it look a bit more conformant. So 1162 days until the low, fat rally, then it goes down to here, 833 days, then it starts to go up, peaks again, and we're not talking, these returns are not small, 426%. And from this peak, we've now been in a 1,120 day downtrend. So we're not still as long as from this peak to here, but again, it's a cyclical sector. So we're getting close to that, historically, how long a stock can be depressed or how long a sector can be depressed before it turns. And obviously, here it looks like, this is kind of a hammer and another hammer. So it's pretty obvious that it's now it's getting harder and harder. And I don't know. I don't think First Majestic has the best fundamentals. I don't think it's a good investment per se. It's like I wouldn't want to. Silver producers overall have a very hard time historically. But again, that can also change because silver has sucked so much that nobody. It's still not. It's 50% down from its 1980 high. So it has sucked for, 44 years basically. And that's why some people believe that, hey, when it breaks out of that cup and handle formation, for example, it could, easily run to $150. And I wouldn't be too surprised to see that. And the less people that believe that's possible, it's like the higher the chance actually is that it could go there. So we don't know. Maybe there's going to be a golden period for silver. We don't know. Nobody knows. We just know that this sector has been absolutely decimated. And First Majestic, for example, is down, or was down 82%. It was down even more over this period. Still, it didn't matter. You didn't need to buy the bottom tick. That's what I see all the time. People tell me, it's like, well, where I see this all the time, that people are like, well, there's still downside potential. That's such a worthless comment, really, because that's true always. There's always downside risk. The bottom tick had downside risk. Why do you think it went down here? Because everybody thought there was more downside risk. At this low here, there was maybe 1% chance priced in that this was going to rally like this. If people knew it was going to rally, it would like this, it would reach this point. It would never be this cheap here or this low. So remember, it's like this is not priced in here. It's the opposite priced in. Down here, it probably was pricing in that the price were going to go something like, this. Or let's say at least dead money for the whatever foreseeable future. This was a black swan. Nobody would sell down here if they thought there was a chance of prices being up here within, less than a year. nobody expects a rally at bottoms anywhere close. Nobody expects there to be a rally within the next few years in the junior space. This is also, I think, a good example just how it's actually not the markets per se, but what we do as investor speculators that, let's say, defines our success. So this is Kootenay Silver log chart. Obviously this is a downtrend, has been since 2008. Very depressing stuff, especially at face value. Anybody can see this is a downtrend. And at face value, anybody will say, well, that's a shitty stock. This is why you can never make money in junior miners. And you can see the crashes here, 88%, 65, 80, 81, 70, 82, 66, 67, 89, okay? But the flip side of that is there's some pretty good sizable rallies in between. Right? 378% rally, 280, 218, and from this point it was 316, 122, 269, 230, 369, 160, yada yada. So what is obvious is that this sector always crashes and always goes up. And this, when you add dilution and you know, silver being a pretty, having been a pretty crappy metal, you have a downtrend like this. But there's still huge rallies, even in a depressing chart like this. So again, I've been looking at a few, you know, juniors lately, and it's like, just look at the volatility. It's like, okay, I guess BlackRock Silver, I don't know when it actually IPO'd. I think it's a relatively new company, so it's like, forgive me for not knowing the history, and I don't know when the, you know, the current BlackRock formed, let's say. But here you have a 1,100% rally, 80% crash, 2,200% rally, and now it has recently, from the top, been down 88%. That's why I'm starting to look at these again. Because going back to Abercrombie and Fitch, %, 90%, and from being minus 90%, it later went up 1,500%. And this is not a junior mining stock even. So anytime anything is down around 90%, in a cyclical sector especially, it becomes interesting to me. Because I know, again, that the future returns can go absolutely ballistic. So again, this drop from here to here doesn't look like much because, okay, I mean, it sucked here, it just sucks more, and people think nothing really happened. But looking back in the future returns might have gone from 700 to 1,500. 800 extra % future returns just from this, I'm not going to say small, but from this 2-month dip here, which in the big scheme of things doesn't look like much. It just looks like it sucks, it's just a degree of suckage. But the implications for the future can be absolutely enormous. A decade worth of returns might have materialized, or a decade worth of future returns might have materialized from this dip here. And it's like I think I've said sometime before, it's like, how do you create a 10-bagger? It's like you have a 5-bagger, future 5-bagger fall 50% in price. The easiest thing to create or to capture future 10-baggers is to buy something in a cyclical sector that goes down in price, especially when it shouldn't. So BlackRock Silver, and they actually have, an asset in Nevada, so there you have, Mexico is having a bit of trouble with the open pit shenanigans. So that's a bit of a wet blanket. But this looks, I mean, it's not like it's necessarily exactly as here, but it's like, okay, went up, went down 80%, formed some kind of wedge, broke down below, and this breakdown here was the actual best point to buy in hindsight, and probably was the most disgusting time for any holder, because this was the inflection point. Right here, down here, was the inflection point. By that I mean this was both the biggest loss and the biggest future return. So if you're an investor that looks at hindsight and lets that dictate, lets the recent past, the direction of the recent past and recent experience dictate your buying and selling, you will feel worst here, less likely to buy, most likely to sell, because you have had experienced the most pain. This max pain period or time was also the max future reward. That is what is so cruel about a cyclical sector, or that's the main reason why even though it's not hard per se as per Pierre Lassonde, in reality, as humans, it is hard, because most of us invest based on emotions and expectations of the short-term future. Here, there was no chance of this happening priced in here, obviously, because these are absolutely outrageous returns. This is a 5-month period of 2,200%. That is absolutely outrageously high returns. Down here, there was almost no chance, like, I don't know, 1% chance priced in of a future just 6 months later or whatever, that the price of this company will be up here. The market down here believed that it would probably be dead for the next few years. Complete opposite happened. Same now, because what I see all the time right now is that in light of this, people think, say it's a dead sector. These juniors are dead. They're never gonna go up, and they are pricing in like they're never gonna go up. And that's what Rick Rule said meant when he said, people have forgotten that these stocks can go up. Down here, I bet everybody forgot that Abercrombie and Fitch could actually go up, or especially down here, looking at this past. This low here led to a 1,581%. Nobody expected that. Nobody. So right now, again, nobody is expecting any of these juniors to go higher anytime soon. Literally, if you look kind of taking into account how this sector works, how fat the rallies are, etc. Basically, if you think there's a shot that there could even be a decent rally within the next 3 years in the junior space, I think that's a contrarian standpoint relative to the market. That is a bet I really, really like. I remember in 2015-16, I made spreadsheets and looked at, for example, silver juniors, some producers, some developers. Just looked how much they were down in absolute share price percentage, not accounting for dilution or anything. I just looked at which were down the most. I bought some First Majestic. Unfortunately, I bought First Majestic around here. I sold around here because I thought it had already become a bit expensive relative to some other juniors. But it proceeded to run like this. But I was, looking at, okay, it was down, 90%. When stuff has gone down 90%, I don't care what commodity it is. You can check uranium companies, you can check lithium companies, you can check nickel companies, you can check palladium companies, you can check platinum companies, you can check copper companies, you can check silver companies, gold companies. Any of those sectors, if the equities are down 90%, you're gonna be in for a real treat one day. And I'm talking broad based on average, not that every single company is even gonna be around. But go and look up any single commodity sector. Look at the equities, what happened to those equities after they were down around 90%. And it doesn't even require 80%. It's like, here it was Kootenay minus 65 before a pretty big rally. Here 70% before a pretty big rally. Here 67% before an epic rally in a short time frame. But when it gets to 80-90%, it's becoming really, really extreme. And lo and behold, where are we at most silver juniors? We're down to like 90%. Here, BlackRock is down 88, or recently was down 88. Southern Silver, you can see these rallies here. I mean, depending on, again, I don't know exactly the backstory, but here's an 1,800% rally, tops out, goes down 90%, 91%, a 1,000% rally, and now it has gone down 84%. If it comes back to the past highs, that's a 529%. And some of these juniors, especially not all, especially when accounting for dilution, but some have actually, created some value. Maybe they've created quite a bit of value in the last 3 years. So even when accounting for dilution, if it reached this level, it would not actually be as potentially overvalued here as it was at the same levels back in 2020. Here you have Summa Silver. Started, I don't know when it actually, I guess this was the IPO or something, 3,000%. Now it's down 91%, and I looked into the SEDI filing. So Allegiant, which is a gold junior, they apparently own shares of Summa Silver. I assume they spun it out or something, I have no idea, but they're selling. So imagine what that does to these juniors when you have a forced sellers. Like another junior that needs money is selling shares of another junior to raise money in an environment when there's no buyers. I have no idea what value Summa Silver should have. They have, I think, 2 projects. I think they're pretty decent. But it's down 91%. So I gotta start paying attention. Because again, look through any commodity cycle. When stuff is down 90%, and that even goes for Abercrombie and Fitch, within the next few years, miracles tend to happen that are not priced in. They are priced in like it would be a miracle. It's like TSXV right now. It is not pricing in a chance of any bull market within the next 5 years. It's priced like it's not going to happen. It's priced like this is not ever really going to rally in our lifetime, I was going to say. But there's obviously billionaires that's betting against that. Because these billionaires believe that, oh right, okay, we're at around this point right now. Oh, I know how this movie is going to play out. Like, I mean, me getting actually interested to buy First Majestic. Why? Because I've seen this movie 1,000 times before. There is 100% chance there's gonna be a rally and a bull market even in the miners sometime in the future. And from the levels we're seeing out there right now, they're so crushed that even if it takes, like Rick Rule, he says, within 5 years, that would be more than worth it. Is it a nice thought? Let's say you bought here, sat through 3 years of suckage, and you hear Rick Rule say, okay, within 5 years, there's going to be a rally. So in your mind, you're going to be thinking, oh, nice, maybe up to 5 years more of dead money. So in total 8 years. Okay? Let's say it would take up to 5 extra years, which I don't think is going to happen. But let's say some of these juniors would be up, or even back to the same levels, let's say. And of course you would want to do some stock picking. That's 413%. In 5 years doesn't sound like much, even though it is incredibly good returns. If you get 400% over every 5 years, you're going to compound like crazy. 100% over 2 years is around 42% compounded per year. 42% compounding per year is a ridiculously good compound rate. That is better than most of the best investors in history can pull off. So, what do you do if you bought high? And in your mind, but again, let's look at the different actions. Okay, let's say you bought here, absolute top. We're down here. You take Rick Rule's comments to the bank that, let's say, we're going to be up here in 5 years. If you could guarantee that, absolute no-brainer. Not many sectors are going to pull 413% over 5 years. Is Nasdaq going to pull 413% over 5 years? I doubt it. Are there individual companies? Absolutely. Are there different sectors that could do that? Absolutely. Still, all we need to know is, like, regardless, that Dogecoin, I mean, maybe Dogecoin goes to 73 billion again. Is that impossible? No, it's not impossible, but that's not the point. Everybody looks at, oh, I should have been in this, whatever, and they talk about opportunity cost. Even if somebody guaranteed that you would get 400% in the next 5 years, most people would not take that bet. Why? Because they think they can do better. Because they have seen Nvidia. They have seen Abercrombie and Fitch recently. This is the only thing that people really invest for. This is what everyone is looking for. Unlimited, I was going to say, exponential rise with no dips. This is what everybody's chasing. And that's obviously why they buy into these moves. Because they think that they're projecting that forward. That it's going to continue to go like this. This is what everybody, especially every losing investor, is always after. That's why they always never buy low. They don't see any evidence of that. And just going back to what I typically say about, okay, you can wait for breakouts, etc. Buy when the sky is blue and all that. So let's take this chart for example. Let's say you did wait. You didn't buy any, in the bad period here because you saw no real trend change yet. You didn't see evidence of a real bull. Okay, let's say you buy after it breaks out. Okay, monthly closing price here. So you buy here after, it confirmed it broke out of this, yada yada. You get 129%. And this is absolutely a monstrous return, even if you did, wait after the close, because that's like 1, 2, 3, 4, 5, 6 months, 129%. Absolute barn burner returns, right? First of all, did you know it was just going to head higher? I mean, this looked like a pretty compelling rally. I mean, it broke this downtrend here, for example. Why wasn't that the start of the rally? Or here, for example, it actually went back and went even lower. So first of all, you never know what breakout, I was going to say, is the real breakout. And you saw it with kind of Newmont. It broke out to a new all-time high a year back or so. And now it's down 65%. So it made one of those, historic, I was going to say, breakouts. It, passed its previous high. And we've seen other markets, they just continue after they do that. Newmont didn't. It went down 65%. So you're risking of buying a fake breakout as well if you want to wait for the market to feel good. But more importantly, okay, you got 128.9% theoretically with no potential margin of safety because you were more like, trading. 128. And you feel really smart because, okay, the breakout was legit. You got 129% in a short period of time. And that's just in this case. It's not a guarantee. Still, okay, how much did actual, let's say, value investors, dip buyer potentially make if they believed in Abercrombie & Fitch, they believed it was undervalued, they believed the cheaper it got, the lower it went, the cheaper it got, the more risk to the upside, it was inevitable that it was going to go higher one day. So they just increasingly added. I mean, look at the percentages. So 1,000%, sure, it wasn't, 128% in whatever, with higher risk because you were mostly us trading it. And how much are you going to go in with here? Let's say you have real confidence in Abercrombie & Fitch. You take up your position to 5% at these lows here, where you get maybe 1,000% in the next few years. Versus you put on a trading position at 0.5%, gain 129%, and there was no guarantee that was going to happen. It was a runaway move. You're more of a trader. How much are you going to dare to put in? Whereas if you have high confidence, high conviction, value investing play, and you might have a 10 times the size and get 1,000% in a few years with lower risk than somebody who put in a trade here, quote, got lucky by the move just being a runaway move. You might look very smart, immediate gratification, probably a very low position, and when you're celebrating your quick tiny trade here, some value investors, let's say, they might have waited a few years, but their returns might be, I mean, just think about it. Let's say you have a 1.5% return or 1.5% position that you get 129% on, versus someone that, let's say it was a high conviction play, they put in a 5% position, and now we're gonna just assume, I mean, most value investors might not really, keep the entire position up here. But if they had a 5% position, imagine if they get 1,000% on that versus your 129% return on 0.5%. It's an enormous difference. Enormous. Not only the returns almost 10 times more, but the position is almost 10 times larger as well. Absolute night and day. But this person looked stupid for a long period of time. Then he made a shit ton of money because he was right. So I'm thinking this is basically the cheapest sector and the biggest dislocation we've seen in juniors since many decades, according to most people. I think it's a matter of when, not if. Well, I know the matter is when, not if, that the juniors are going to go into a bull run again, especially at least a bull leg, but maybe even enormous bull market, like happened for Abercrombie & Fitch. And we see again, going back to where do I have that? Nvidia, not Nvidia, Nasdaq Hue Index. We just surpassed the top from 2000. This is what happened after that. Again, this is the TSXV right now. Completely depressed. Nasdaq totally roaring. But what happened after? Nasdaq made a peak that it would, I think, take 14 years to recover or something. Miners went on a 11-year bull run. So this was the inflection point. Max Payne, and I think we're very close and maybe even have passed this inflection point here in TSXV. And this was the inflection point in Abercrombie & Fitch. I think we're around these levels. Oh yeah, and here we have Western Alaska, silver base metal play, up 784%, down almost 92%. They recently put out the resource estimate, very high grade, excuse me, on a AG equivalent basis, 75 million ounces AG equivalent. Not a huge resource, insanely high grade, 1/3, I think around 1/3 in silver. And of course, like, you know, probably can see in some comments, I assume. Okay, maybe not too much chatter, but it's like, okay, how much did that matter? Okay, they put out a resource, it bumped for a short period, almost back to even. And the market cap is 26 million. Do they have a mine there right now with this resource? I don't think so. I think they need a bigger one. What is priced in of them ending up with something worth mining here? Not much, because a mine worth something would probably be worth 20 times this market cap. Is there a guarantee they're gonna get it? No, we can only play the risk reward. And okay, why doesn't the market care? First of all, nobody's in this sector. Nobody cares. Nobody cares about the news. You see stocks sell off on good news. Yada yada yada. Okay, so we know, again, it's the sentiment. It's a silly sector. Okay, so you can't take anything personal. You can't derive much due diligence from any price moves at this point. It's just more a matter of liquidity events and all that. And also, okay, Western Alaska, what do they need? Money. Who knows that? Pretty much everyone. So what is people thinking? As soon, you know, okay, the resource is out. Everybody's looking for the next short-term thing, obviously. Okay, they think that that's a financing. How many get excited about buying a junior that's gonna finance when they're already tired of juniors? I mean, not many are gonna buy that. So it's like a lot of things in this sector can be explained when you think about how we work as investors. People don't want to buy something that's in a clear downtrend. People want to buy stuff that's in a clear uptrend. When you know, okay, the market thinks there's a placement coming, why would I want to buy that? Even less recent people, you know, seen buying. Makes perfect sense. But if we draw out the timeline a bit, could there be any positive surprises from this market cap? But then, okay, they need to raise. Let's say, I don't know how much they would be raising, but let's say the market cap goes up to 30 million. Are there any upside surprises with a, you know, Alaska focused junior with 75 million ounces of AG equivalent, that has a lot of exploration potential. You don't know they're for sure gonna find a mine, but it's like, is it possible? Yeah, for sure is, given how these CRD systems work. If they tap into the next part of this, skeletal finger, as they say with CRD systems, could they have a mine? Then yeah, okay. What again? What's priced in that they will actually find something? It's like, okay, 30 million, pricing in 1/10 of a $300 million project. That would be, I guess, a decent mine, a good mine, maybe 600 million. Okay, it would be pricing in 1 in 20 of that happening, excluding more dilution. Still, I mean, you don't need to, do too much thinking to realize that, okay, it's from a fundamental perspective, it's not pricing in very much of a chance of finding anything worth mining. And then you kind of have to account, well, okay, is it pricing in the, how much of a, let alone fundamentals, just the fact that sometimes these juniors go into a bull cycle, regardless of, their fundamentals, like we're seeing with these market caps, that they simply trade up and trade down. It's like, okay, how much of a sentiment uptick is priced in? Well, not much, obviously, because this sector is pricing in there's not going to be a rally within the next few years. So if you wanted to have a lot of ways to win, that would be buying some cheap juniors right now, and especially the ones that have some project, some resource or something that could have then beta to sentiment and metal prices. So it's like, here we have Eloro. They're kind of, I would say, stuck in the same. It's like they have an enormous resource, low grade, most of it low grade. Look at some of these runs here. It's like, okay, here's like just from this point 1,100, 3,000%. Okay, it goes down 79%, so it actually outperforming the average junior. Which is, I mean, greatly outperforming since 2020, but still, okay, down 79%, which you see is like, that is typically what you expect to see, or even worse in silver juniors. Okay, what's happening now? Well, I think the market believes there's going to be a placement coming. So that's like, again, one of these bad carrots dangling in front of the market. You don't really need to know more than that. It's just shitty. The sentiment is shitty. We're somewhere around this period here, depression, let's say late stage depression, and for like two of these companies, and there's a bunch of other juniors, where it's like the market thinks, well, they're gonna take in money. So they're, front running dilution. And the thing with that is that in those cases, typically, it doesn't matter how cheap it already is, because people always think, well, there's going to be a negative reaction on the financing. And we've seen some pretty brutal financings. But in the grand scheme of things, I mean, even Line 1's financing, did it suck? It's like 3-year full warrants, discount to market, pretty hefty discount. Yeah, that sucked. I don't know what the exact dilution difference is between, a better or good financing versus that, but that's like, that's it. I mean, that's the, let's say it added 10% in dilution. It's nothing to sneeze at, but it's like, in the big scheme of things, if you cut off some of these rallies by like, okay, 10% less potential because more dilution at the lows or whatever. It's like, yeah, instead of 466, you would get like, 420%. That in the grand scheme of things doesn't matter too much. No, it really doesn't. But that's how the market works. It's short-term focused. If the market believes, it's like when Western Alaska ran up. Okay, the visuals were around this time. We had visuals unusually saying, okay, we have hit 100 meters of massive sulfides. What price is too high to buy in that case? Because everybody expected that those assets are going to be great. And the default set is whenever they come in, it's going to go higher because they're going to be great assays. I think the top was on assay day. Why? Because again, everybody was buying because they thought they could sell higher on the day of the news release. So there was a lot of pent-up selling. A lot of people that thought, well, okay, it's going to pop 50%, whatever, on the day of the assays because they're going to be good. So everybody has piled in before the assays. And a lot of them had the intention of, I'm going to sell on the assays and I'm going to book a quick profit. Well, there was obviously enough of people that were thinking along those lanes. So when the news release came, that marked the top because there was so many people that were ready to sell immediately. And it wasn't a shock to the market because everybody kind of knew that the assets were going to be good. But we are in the opposite in a lot of these juniors where it's like the market knows that the next news release is going to probably be a financing. So in the minds of investors, there's never too late to sell, never too cheap to sell because they think it's going to go lower on the announcement. That's why you have some of these absolutely wicked wicked volatility. And therein lies the opportunity. Because this is a cyclical sector, it's forever going to be a cyclical sector. And now we see stuff out there down 90%. And historically speaking, look at any commodity sector when the equities are down 90%, what happens within the next few years? They tend to be up a lot. Not 100%, not 200%, several hundred of percent, even sometimes 1,000%. And considering where we might be in the index, it's like we might be in for the. I mean, I think we're at the. I personally think that we're in for. I think we are somewhere close to this period here. This top in this ratio, this depression low, this sector was so hated here that it produced an 11-year bull market. The market was so loved here, this sector was so loved here that it produced a 13-year bear market. And now it's so hated that it might produce a 11-year bull market again. This is a log short of the CDN. So going back to Abercrombie & Fitch kind of thinking, okay, this is the log short. This looks a bit like we have seen. I mean, here you have, is this log short even? Okay, it's not actually log short. Still, so here you have a resistance line, okay? Or major peak, resistance, third time. Here we have major top, resistance, third time. So log short, it looks even closer to Abercrombie & Fitch. So I would say, I think the whole TXV is around here. I think we've seen the depressed lows, the peak depression. I think we're forming this part here of the depression cycle. I think something along the lines of these moves here in some way, shape or form are in store for us within the next few years. And I know what happens with silver beta when it runs. So again, a bit more speculative, but hot damn, can these silver juniors produce rallies. And I mean, blue sky scenario is that not only do you have the backdrop of the TSXV going from I don't know, what's this, 2009 or something. It's like, let's say a 15-year bear market. Maybe we're in for a multi-year bull market. Plus, maybe, just maybe, the biggest and most depressing shorts of them all, which is silver, is going to complete a cup and handle breakout. So just imagine what would happen if you have a TSXV, the broader index, starting a multi-year bull market within the next few years. You have silver potentially breaking out of a multi-decade cup and handle pattern over the next few years. Plus, and silver can really run when it gets going. You can, I mean, this move here, 2008 to 2011. I mean, just this move here, for example. So it can move extremely quick when it goes. As we can see back here as well. I was gonna say, I mean, consolidation, then just boom shot. I mean, like literally a moonshot once it gets going. Nothing, boom. Nothing, who knows? So just imagine what some juniors how much some juniors could go up in that case within the next few to maybe 5 years, if we're gonna be conservative like Rick Rule. Then back calculate how ready you should be, or how able you should be to wait for that, and how little it actually means if you're down, let's say 50% right now. That is, yeah, I mean, take those three things together. It's like maybe the whole venture exchange is around this level, in for a big move. Silver is forming a cup and handle, and you know what these juniors can do in a typical bull leg. Just a bull leg, not a full-blown bull market, but it's like just a several month long bull leg. They can go up 500 to 1,000%. Imagine if all those three things come together. Yeah, so long winded rant as always. But yeah, that's the main reasoning I was gonna say, because I've seen what happens to silver beta when it gets going. And I remember what happened last time I bought them, when they were down around 90%. And it's not like I'm betting the farm on any one of these, because I mean, personally, silver is a hard sector overall. It's hard to make money. The sector has been depressed. That's why most silver juniors become gold miners. But that also could change, given how sucky silver has been. And is that going to happen tomorrow, next month? I don't think so. I mean, even if it started tomorrow, I mean, let's put it like this. Even if we're around here, it's not like it's a miracle, the month after. No, it gradually starts. And this is disbelief. Obviously, nobody thinks this would go through here. When it did, boom. And most people, again, they are waiting to be part of this move here. But my point, my opinion is that you buy when the margin of safety is the highest, when they are simply the cheapest, because then it doesn't really matter how long you wait, because the odds of you making money is much higher than the odds of you making money, meaningful money, just by buying every runaway move, which could be a false break. And yeah, you're gonna simply make a lot more money. And like I say all the time, I mean, look how it doesn't look like much, but look how the future returns just go completely bonkers. Like, okay, here's like 300, 400, 500, 600. I mean, it's just unreal. So it's the best offense and defense. Thanks for listening. Consider me biased. I might own shares of any company I mentioned here. Some are sponsors as well, so do your own due diligence. And yeah, I mean, I'm not going all in silver beta. That I can tell you, but I am slowly starting to add some. Not because I think they're the best companies necessarily, or they're cheaper than the gold developers, for example. It's just that I've seen and I know what happens to the silver space once it gets going. And once it's been down 90%, good things tend to happen afterwards. Thanks for listening. Bye bye.